Hey, it's Eric with Jazz Wealth Managers, where we don't just invest your dough. We like to educate you. And honestly, we like to try to make sure that you keep as much dough in your pocket as possible and not make the wrong decisions. So that's what I want to talk about. Some people are going to get a little upset. They're going to say, well, I did this because, and if you got to justify it, maybe you made the wrong move. So I want to talk to you about these mistakes that you could make going into retirement to make sure that you're not making them, especially right now during the volatile market. So let me share my screen and show exactly what I'm talking about. The first thing is really just talking through, volatility and not making the wrong decisions while the market's volatile. Because, if you look right here, this is the S&P 500. If you look, we kind of got used to this, well, other than right here in this crazy little time in 2020. But beyond that, we were used to just a nice growth opportunity in the stock markets. And then over here, 2022 happened. And then now we're going into 2023 and hitting this roller coaster. If you zoom in quite a bit, you can see it a lot better. And you're seeing this. So many people get to this moment. And if we go back to the screen here, we take a 3-year look, or let's say a 5-year, we're going to say, all right, well, you know what? Now that the market is falling right here, that's where you want to go more conservative. That's where you don't want to, lose all of your money. We hear that a lot. That's a mistake, because that's not the time to try to go more conservative. And instead, really, point number 2 is before that time is when you need to start to reallocate for retirement years. So for planning purposes, starting to really look at what you're at right here while the market's going up. Don't get too greedy, and instead thinking through actually pulling back for the retirement years. Maybe you adjust from 100% in the stock market to maybe an 80-20 allocation, or a 60-40, 60% stocks, 40% bonds. Or maybe you create that certain bucket over here that's the quick cash. This is, hey, if the market does fall, because nobody knew exactly what was going to happen and when it's going to happen. We don't know, not even financial advisors have that crystal ball like some people think. But what we do know is that there's going to be volatility in the market. There are going to be times when the market is down. And so finding the areas here where we can take from the top, creating bucket 1, so that when bad things do happen, you're not having to sell low, and instead you're able to then pull from that money for the short term. That can also be done in an actual investment portfolio. You could create an investment portfolio that has some things or some funds that may be, hey, this is the bucket 1 money within my investment portfolio. That's what we do here a lot with Jazz. So if the market's falling, maybe this fund isn't going to fall as much. Oftentimes it could even rise. Consumer staples is something that oftentimes doesn't do near as bad when there's a lot of market volatility or a lot of falling markets, because consumer staples is something that people say, hey, we have to go to the grocery store. We have to go buy these things. Versus another one that's a high flyer when the markets are really good, and that's called consumer discretionary. That's something such as automobile industry, where people are like, well, hey, I'm making all this money. The stocks are good. I'm going to buy more vehicles. But when things get tight, when things like the R word of recession gets thrown out there, you got to watch out, because that's where those types of sectors could potentially fall off. So really making sure that you're there. And so that's 2. The third one is something that a lot of people get a little greedy here when it comes to this, and it's just failing to diversify. Now, this chart right here is 3 years of Tesla. And Tesla was a hot stock, especially 2020, early 2020. You see the rise, and so many people rode this up. But oftentimes, emotion doesn't let you get into the stock until you're already way over here. Well, if you would have bought this in July of 2021 at $220, you would actually be down now. You would have had to get in this thing a long time ago before you actually hit a point where there was a break even. Let's see exactly. We're at 191. So you would have had to buy this close to the end of 2020 to actually get in and break even on this stock. And so it's making sure that you're diversified. You're not just wanting to be all in on one stock to get rich quick, because that can also make you broke quick too. So just make sure that you're doing those 3 things, diversifying, that you're not trying to make massive adjustments. Once the market has fallen, you're able to manage your emotion there. And then also talking through with your advisor, or if you do it yourself, making sure that you do look at your portfolio and adjust for those upcoming retirement years. 3 different things to think about. If you haven't checked us out, jazzwealth.com. We'd be happy to help you here.
Thanks for watching. If you want to watch more FinTips videos, click here. Be sure to like and subscribe also.